Welcome to The Explainer. Today, we're unpacking a really fascinating financial story from the aviation world. We're digging into Southwest Airlines' second quarter 2026 results. And right at the center of this report is a pretty incredible conflict. On one hand, you've got a company achieving record profit margins. But on the other hand, that exact same company is facing a nearly billion-dollar wave of completely unexpected fuel costs. So how does an airline absorb that kind of hit and actually still come out on top? Well, that is exactly what we're going to explore today. Okay, let's dive into this. The official header from their Q2 2026 earnings release sets an absolutely unmistakable tone. Southwest leadership isn't just handing over a spreadsheet of numbers here, they're making a huge statement. They literally titled it, Earnings Power on Full Display. It projects immense confidence, letting investors know right out of the gate that their transformational initiatives are actually working. To really understand this quarter, we kind of have to look at the narrative arc, which essentially pits our hero against our villain. The hero of this story is Southwest's top line, an all-time record operating revenue of $8.4 billion. That's a massive 16.4% jump. But the villain? A staggering $889 million year-over-year increase in nominal fuel costs. In the airline industry, a sudden expense approaching $1 billion usually spells absolute disaster for quarterly earnings. Yet, somehow, Southwest defy the odds. So here is our flight path for today. We're going to methodically break down this dense financial report into 5 clear sections. The Q2 big picture, record revenues, the fuel cost headwind, fleet upgrades, and finally, their 2026 guidance. All right, Section 1, the Q2 2026 big picture. Let's look at the top-line figures that completely defined Southwest's second quarter. I really want to focus on this quote from CEO Bob Jordan because it perfectly captures their resilience. He says, even in a volatile fuel environment, we delivered significant earnings growth and margin expansion in the second quarter, and are positioned to do so for the remainder of 2026. He's directly acknowledging the total chaos in the fuel market while simultaneously declaring total victory over it for the quarter. So the crucial point is really in these bottom line numbers. Southwest reported a net income of $233 million, or 47 cents per diluted share. But when you look at the adjusted net income, it leaps to $465 million, or 94 cents per adjusted share. And the real standout figure? Their adjusted operating margin hits 6.7%. That is a massive 3.3-point jump year over year. They didn't just survive the quarter, their margins actually expanded. Now, you might be wondering why there's such a huge difference between the standard net income and the adjusted net income. Well, it comes down to something called breakage revenue, which we definitely need to translate from financial jargon. Basically, between 2022 and 2025, Southwest issued non-expiring flight credits. Breakage just refers to the assumption of how many of those credits will simply never be used. Due to higher-than-expected redemptions, Southwest had to make a one-time $285 million accounting adjustment to revise those estimates. Because that $285 million charge is tied to credits issued years ago, treating it as a special item and excluding it from the adjusted results is absolutely vital. By removing this one-time accounting quirk, investors get a much truer and, frankly, a much stronger picture of how Southwest's real day-to-day operations performed during this specific quarter. Moving right along to Section 2, breaking down record revenues. If the underlying operations were that strong, how exactly did Southwest hit that staggering $8.4 billion record? Now, what's really interesting here is that their growth wasn't just driven by selling more standard passenger tickets. Look at the momentum across these diversified revenue levers. They saw a 30% increase in managed business revenues, actually hitting an all-time quarterly record for corporate travel. New enrollments in their Rapid Rewards program shot up 35%. And acquisitions for their Chase co-branded credit card accelerated by 28%, seeing double-digit growth every single month of the quarter. And all of that loyalty momentum brings us to this absolutely incredible milestone. Nearly 100 million members are now enrolled in the Rapid Rewards program. Thanks to record tier qualifiers and that huge surge in new enrollments we just talked about, the program has grown to its largest size in company history. This is a massive, highly engaged customer base driving recurring revenue. Section 3, the massive fuel cost headwind. As impressive as those revenue records are, it's time to face the villain of this explainer and the major obstacle Southwest had to overcome. And this right here brilliantly illustrates the sheer magnitude of the problem. $889 million. That is the year-over-year spike in aircraft fuel and related taxes expense. Just imagine running a business and having one of your baseline operational costs randomly surge by nearly $1 billion in a single quarter. Let's break down the actual math on how that happened. In Q2 of 2026, Southwest's fuel cost hit $3.92 per gallon, which drove a 67% increase in fuel expenses compared to the exact same time last year. To put that into perspective for shareholders, that single factor represented a massive 1.17 drag on their adjusted earnings per share. The fact that they still posted 94 cents of adjusted EPS despite a 1.17 headwind shows just incredible underlying strength. Section 4, Strategic Fleets and Tech Upgrades. Southwest isn't just relying on clever financial engineering to drive revenue, they are making tangible product upgrades to win over passengers. Honestly, these consumer wins are fantastic. During Q2, they officially operated their first Starlink-equipped aircraft, which really kicks off a new era of high-speed in-flight connectivity. They also took home the J.D. Power Award for #1 in economy customer satisfaction for the 5th consecutive year. But perhaps most strategically, they are physically removing 6 seats from their Boeing 737-700 fleet specifically to offer extra legroom. Yes, you heard that right, an airline actually giving you more space. They are trading raw density for a premium customer experience. Plus, they expanded their global reach by welcoming Air Premia as their 9th partner airline. Section 5, Looking ahead to 2026 guidance. Let's move on and see how this builds, transitioning from the historical Q2 data to their forecast for the horizon. Let's translate some of this airline alphabet soup for the third quarter projections. They're forecasting adjusted EPS between 50 and 75 cents. Capacity, or ASMs, will be slightly down or flat. But look at RASM, that's unit revenues. They expect it to skyrocket by 17.5 to 19.5% year over year. Meanwhile, CASM-X, which is their non-fuel unit costs, is only expected to rise 3.5 to 4%. And that actually includes the cost of taking those 6 seats out for extra legroom. Keep in mind, this solid Q3 forecast is based on an assumed forward fuel curve of $3.70 to $3.75 per gallon. Taking a wider lens, this is the really critical figure for the entire year. Southwest is guiding for a full year 2026 adjusted EPS in the range of $3.25 to $4.25. This is important because it totally replaces their previous, much vaguer expectation of at least $4. By establishing this specific new target range, leadership is putting a firm stake in the ground regarding their earnings power through the end of December. Which brings us to our final provocative thought. We've seen Southwest pull off a stunning David versus Goliath victory in Q2, leveraging business travel, loyalty programs, and an upgraded cabin experience to completely overpower a 67% spike in fuel costs. But the ultimate question to take away is this: can Southwest's diversified revenue levers continue to overpower the volatility of fuel costs as we move through the second half of 2026? Their guidance definitely suggests they are more than ready for the fight, but as we know, the volatile energy markets always have a vote. We'll definitely be watching closely next quarter. Thanks so much for joining us for this explainer.